Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Hello, Global Investor listeners. Before we start today's show, I want to let you know about Belgrade Homes in Tyler, Texas. They're offering newly constructed 130 square meter, 1,400 square foot homes for $145,000. They are offering financing to U.S. and foreign investors for 30 years at 6% interest with a 30% down payment. If you're interested, please contact belgradehomes.com, spelled BEOGRAD homes.com.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Jack Aduwo. Jack is a real estate syndicator with 1,000 units across 4 states. He started investing in real estate over 10 years ago with single-family properties and has since transitioned to multifamily real estate. So thanks so much for being on the show, Jack.
Yeah, thank you. Thank you, too.
So what was your professional background prior to starting real estate investing 10, 12 years ago?
So I've been in the IT industry, like a lot of, for some odd reason, a lot of people in the multifamily space, a lot of them always have some kind of IT background. So I have an IT background. I'm actually still have my 9-to-5 job. I've been in IT about over 15 years now. It's been a good run, can't complain. Yes.
And then why did you choose to get into real estate years ago?
So, so this like about around 2009. Me and my wife, we just got married. I got a job with HP as a software developer in Idaho, and so we moved to Boise, Idaho, and we moved from LA. So as you can imagine, moving from LA to Idaho, all of a sudden, houses were like pennies on the dollar, So we bought our single family, our primary home, that is. And, after we bought it, I remember clearly there was a house we wanted to buy, and we had put an offer, and they declined our offer. And that's after we bought our primary home, it came back on market, and it came back even at a lower price than what we had originally put offer on. And we had some money left over, from the wedding and just savings. And then we decided to invest that money into to buy that single family. And I remember the price was about $80,000, and there was a tenant on it already paying about $900. And so, coming in, no experience, zero experience, I just saw that there was an opportunity to buy it because it was so cheap. And if somebody can pay that much, I think my net profit was about $400. I think mortgage was coming to about $500. And so I was like, holy smoke. From day one, we bought it as a short sale. And the day we bought it, I just went to the property and gave the tenant notice. Hey, I'm the new landlord. So please send all the payment to me and everything. I did not even ask for a deposit, because I was kind of learning on the go. So he just started sending me money from next month, and it was the best feeling ever. All of a sudden, I have this $400 coming to my account, and I'm not having to do much. And I was like, holy smoke, yeah, I got to invest more on this. So around that time, we basically, we did not know any other financing strategy, how to acquire more property with different financing. So the only thing we know was save and buy the next house, save and buy the next house. We didn't have any kids at that time, so it was pretty much, trying to live a frugal life and save as much as we can and use that money to buy the next house. So basically every quarter we were buying a house, on average, every quarter buying a house. And after we bought more than 10, then all of a sudden, the time is you get Fannie Mae and Freddie it out. So we couldn't get any more the sweet government-backed loans. And this like over 5 years ago. So the financing market was still a little, The financing market was still frozen or strict. So any lender that was going to give us loan was basically going to give us loan on their books, and they all started, basically demanding for more money. I remember talking to one lender based in Idaho, one of those regional lenders, and they wanted 12-month cash reserve for every single house we had, which means they were basically assuming that we can easily go 12 months straight with all the houses being empty and not a single person paying for rent. I mean, it was just crazy. Boise was still growing even through that time. Boise has always been growing, and it was like kind of ridiculous. And in addition to that, they also require like 30% down payment, and interest rate was well above, I think, 200 basis point above the going rate at the time. So it was like, 5 something. And so I was like, oh, forget it. So I started looking into other ways to finance deal, and that's when I learned into multifamily, that if you buy it bigger, then all of a sudden the financing strategy changes. So I started looking into multifamily.
Yeah. So before going into multifamily, what were you doing with those properties? I know you were renting them out at the end. Were you flipping any of them? Were you rehabbing any, or were you buying these pretty much turnkey and then just renting them out for cash flow?
I think that would make it very attractive. So this Idaho, so this is like early 2000, right? No, not early, but 2010s, right? So I would buy a house that was built in 2005, and I bought it in 2014. So it's literally less than 10 years old. It's basically a turnkey. So I'm a buy and hold. I've never sold any of my property. My goal was to buy a house because, I have my job, so I have my 9-to-5 job, so I'm not trying to be a flipper. I can be a flipper, but it's just going to be another extra work in addition to my 9-to-5. So if I can get something and just buy and hold it and just let it cash flow and grow in equity, I love it. So that's always been my goal. I've never sold any of my houses. I don't plan on selling them anytime soon because I believe they're just good cash cow, and I can hold them forever. And it's a generational wealth. I can, give them to my kids, down the line. And so I've not seen a need to sell them.
So you mentioned financing was a determining factor for switching your focus to multifamily. Were there any other determining factors? Because I think with real estate investors, obviously the financial part of it is a main factor, whether it's having enough equity or being able to acquire debt to move their investing career ahead. But what else other than the financing attracted you to multifamily?
So at that time, I did not know much about multifamily. Like a lot of people, I thought it was meant for the big boys with the big money, and not for people like me. And so to me, it was more or less like, being caught up in a situation whereby, I got to look for alternatives. So I did not know much about all the benefits that multifamily has. So it was a matter of just starting to research on, okay, I can't get any better financing factor. So what basically stopped me from single family was purely financing factor.
Yeah.
And then, of course, when I get into multifamily, I found all the other great benefits, like, for example, when I started looking into multifamily, finding that, all of a sudden you can get a non-recourse and I can get a bigger loan, and all of a sudden I can get a loan where they don't care how much I'm earning. And it was just like, whoa, where have I been all years, I wish I knew this way back then. I don't know. I don't know how much Boise apartment were going on at that time, but if I knew, the multifamily financing, I probably would have definitely gone to multifamily way back then. Yeah, right. No doubt.
Yeah. So the financing definitely the major thing, because once you allot all your available mortgages, you're kind of tapped out, and now you have to figure out a different way of financing your next property. So what is your what is your current investing strategy right now within multifamily? And I know you're in some other asset classes as well.
Yeah, so with multifamily, I'm basically having two approaches. One is being a passive investor, so I'm looking for deals to be passive investor on. I have some IRA money to invest and also my own cash to invest. But also do syndication. I'm more focusing on syndication, but of course, I know a lot of great multifamily sponsors out there, and whenever they have a good deal with the numbers working and look really great, I would jump on it. But the focus, that I spend on my multifamily investment time on is, acquiring more deals and looking for more deals. It takes a lot of time, a lot of effort to, look out for deals and get deals for sure.
So what is your role within your company throughout the acquisition and asset management kind of stages of it? Are you finding the deals? Are you finding the equity? Are you performing asset management, project management after they're acquired?
So I've been kind of a jack of all trades, to be honest, with regard to multifamily syndication. So basically playing all those roles. My first deal, I know, for example, I knew the broker, worked with the broker, sourced the deal, basically brought my partners into the deal, and we did the whole acquisition process, raising money, doing everything. And now we're all doing the asset management, basically weekly call with the property manager and doing everything. As time progresses, and the definite asset management, no doubt, takes a lot of effort, because it's, initial thought like, oh, property management company is gonna, run the show, and we just gonna check in, make sure that everything is being done. But no, asset management is a work by itself, and actually when you work in the value-add space that we do, like the one we do, you cannot just come in and acquire the property and say, oh, I'm going to asset manage and not do much. Every single day there's something to be done with the value-add asset. So more and more, my approach going forward is to work with partners whereby, because I'm not going to be able, the reality, I'm not going to be able to do 100% of the asset management if I want to acquire more property, because these ones are taking more and more of my time. So it's a matter of, working with partners, and make sure that we structure it like that, I don't have the same, in other words, one of the key partners kind of help, do a little bit of extra work with the asset management with that regards.
Yeah. No, I agree totally.
Yes, so that I can be able to spend more time, acquiring properties.
Yeah, everybody has their specialty within the whole process. Yeah. And when you focus on that, it benefits everybody because, it's just everybody. Some people are better at asset management. Some are better at underwriting and speaking with brokers. Some are better at raising the equity portion of the deal. So it's just everybody has to play to the strengths and also play to their available time. Obviously, if you're still working full time, it's something where, asset management being very time consuming, because pretty much you're managing the business. You have, a manager for your business, but you're actually managing them. So it's a very, especially when you have the projects going on, because none of these properties we're buying are really turnkey. These are all, like you said, value add properties. So there's an ongoing project for possibly 2 years, and this time right now, maybe more, but
no doubt. Yes.
So speaking about this time right now and what we're going through, how has your business changed because of COVID? Maybe like what your buying's changed, how you're buying it, how you're managing it.
So, as Warren Buffett always say, when they run to the hills, or that's when time to get deals, or when people are less greedy, that's when you can be greedy. So I believe anybody who's selling right now is a motivated seller. Let's face it. So I'm looking for deals. I'm looking for deals right now. My underwriting has definitely changed to reflect the market. For example, all my new deals, I am assuming zero income year one. And what that basically zero income increase. So in other words, what I'm basically saying is I come in and I'm not going to raise a single penny on that deal. Can the numbers still work? If I'm Now, based on the T12, you take the T12, the way it's been operating the last 12 months, and assuming you're not able to increase on any of the income, can I still get the numbers to work? And to me, that's one of the way I'm checking if the property works. Of course, also still doing, COVID-19 stress testing the deal and all that stuff. But the underwriting right now assume none of that. And also typically on year 2, I usually, like for example, in a market like Dallas, I would assume 3% increase on year 2. Right now I'm using 0% increase on year 2, or maybe in some case 1%. Or 2% depending on the area, but basically rent increase on year 2 is also extremely limited. Overall income on year 2 is solidly below 10%, no more than, say, for example, 7% on year 2. So I try to give myself room such that just in case it goes beyond year 1, we're not fully recovered. I don't have expectations that's not achievable on year 2.
No, I totally agree with that. We're doing the same thing. We're not writing any increases for the rest of 2020 for our underwriting. And then we're very, very bearish, I guess you would say, on increases for 2021 until we've started actually bringing some of the new apartments on and turning over and stuff like that. But yeah, we're also getting longer interest-only terms. Used to be just 2 years. Now we're going for 4 years interest only. Just gives us more of a buffer when we're buying it. So how has managing your business changed during all this, all your properties?
Yeah, so we're definitely having to pay more close attention to the rental income. I mean, I think everybody was completely freaking out back in March. I was one of them too. And I don't think I freak as much as everybody. Some people do, but I was more or less on the positive side, because when you have a sound. So one of the things we tested initially was stress testing our property, see how they would perform, right? And we definitely put all the capex on hold for a little bit. I know one of our property we did not, because when we stress tested it, we could get up to 45% occupancy and still get the numbers to work. So we're like, okay. I mean, how will you get to 45% occupancy? So we just felt very, very confident that no reason to, put any of the capex on hold. So we've been actually continuing the capex, and that property we acquired in February of this year. So we still have basically up all the initial capex. It's not like we are, on the tail end of the deal whereby we have very little money left on the capex. We still have a huge amount of capex, so give us peace of mind that, hey, if anything changes down the line, we can reassess it, but we can continue. Some other properties we basically decided like, hey, let's just put everything on hold a little bit to see where things are. But we are basically this month we've decided to restart some of those capex, the interior upgrade, exterior renovations that we decided, because we do not see any reason to hold back. All my properties have been doing great. I know, for example, one of them, we decided we were initially planning on implementing internet package on the property for $89 per door, and we kind of delayed it a little, but just the way things have been, that property has constantly stayed at 98%. Wow. As a matter of fact, back in March, it was like 94%, and throughout all this time, it got to 98%. I mean, there's no reason to delay. We can take the chance. So we're just going to, next month, we're just going to proceed with the implementation, next month being July, that is. And, because we're not just too concerned. Another property, this one is, for example, in Phoenix. I mean, we still get a huge traffic of people coming in, and our rent have been low, that we decided we're just going to start increasing rent. We're not going to wait anymore, because, it's a matter of seeing what's on the ground, talking to the management company, seeing what they're seeing, and, if there's a strong interest, the traffic's still there, and people are still interested, and you try one unit with a rent increase and nobody's saying no, then we're like, hey, let's have it. Yeah. So I think my luck is all the property we got, we've been very fortunate to have them in locations, and I'm a strong believer in locations.
Yeah.
In trying to buy property in the right location in a growing area such that you can be able to easily, weather the storm, like, in this case, COVID-19.
Yeah, no, for sure. And we were reviewing some of our vacancies. We went from 94% economic occupancy, so people paying rent prior to COVID, to on one of our properties to 98%. So you have a lot more people staying in the properties. Obviously, we've paused a lot of interior renovations on that one project, but we are still, like you said, we're still doing our exterior project renovations and stuff like that, because that's all part of the whole business plan. And that doesn't even really affect the rent, because no one's going to pay for them to have pay more for a non-leaking roof, for example. But so what do you see? We talked about your properties. What do you see as all for 12 to 24 months, let's say, for multifamily? What's your 30,000 foot view?
So I think I am more bullish on the multifamily, because I always feel like, and the industry data shows, when you look at all the reports out there, right? I think there was a time, was it RealPage or one of the marketing, one of the industry reports out there? I was actually looking at one of the Neil Bauer's presentation, and it shows how different industry were going to, be affected by COVID-19, and multifamily was on the bottom end. It was not the lowest, which kind of makes sense, because I think the lowest was like self-storage, because when people lose their home, they still have to store their stuff somewhere, plus just operational point of view. And, COVID-19, nobody's going to, but you have a less likely chance of getting COVID-19 at self-storage,
right,
compared to getting it in an apartment. So I'm very bullish. I think there's going to be slow down, which from a buyer point of view is really good. I think there's going to be some markets that are going to feel it really bad. The most obvious one, of course, is Vegas and Orlando. And, I think this is the best time to look into those markets that that are overwhelmingly affected by this. Some markets are definitely not going to feel it. I was just looking at which report was that? Was it Forbes? So one of the reports showing, for example, Salt Lake City and the Boise are some of the markets that are going to easily weather the storm, just because of the way they are. A lot of markets like Austin, for example, that have a lot of technology presence. If there's one industry which is not going to feel a lot of this, is technology, because it's one job that a lot of people can easily do without coming to the office. I have been working from home since March, because I'm in the IT. Even though my company is not an IT company, but with me being in the IT, I can easily go a lot long. I don't have to go to the office. I can stay in the home basically forever, because all I need is just two things: my laptop and the internet, and that's it. So it makes it very easy. So I think, so if you're wearing two hats, if you're wearing a hat of a seller, if you have a loan deal, definitely, you have a little bit you might be expecting to give some kind of discount. If you're a buyer, I think there might be some discount. Some markets I don't expect much discount at all. Austin, Salt Lake City, for example, I don't expect much discount at all. But if in certain markets like Houston, I would expect some kind of discount.
Yeah. No, I agree. And I like how I think the same way. We were talking about Nevada and Orlando, and I'm based in Florida. We're really bullish in certain areas. We don't have any holdings in Orlando, though. But it's something where stuff that comes in from there, from brokers, we review and we take a look at. And, I don't think you can just say it's a no-go in these areas. You always have to kind of see what people are looking for. The prop. Yeah, it's all deal by deal. Every area is a little different. Different classes differ in these areas with not as diversified employment, whether, like Las Vegas and Orlando, for example, they're not the most employer diversified kind of places. But I think, what we're looking for too is that if we're looking in I think places are going to be much more stable where you have a
Mm-hmm.
diversified workforce, where you have,
Mm-hmm.
and then you've had the consistent population growth as well, like the places even you mentioned there as well. I don't think you're going to see too much change in that, in those areas. But
Right.
what mistakes have you made in real estate investing, and what would you highlight to a new investor?
There's definitely always, learning lessons. I've made both mistakes, both as a passive investor and also as a syndicator. Syndicate is not more or less my mistake. It's just, a learning lesson. So I had a deal, we were acquiring the deal. This is my first deal, and the deal had a chiller. And about 2 weeks before, we closed the deal, the chiller caught fire. The seller was selling to us at a good price because they didn't want to deal with the chiller. And because it caught fire before we closed the deal, they now had to replace it. And, of course, all of a sudden, a new chiller, the property value significantly goes high because of that. And they turned around, they basically decided to walk away from the deal. So, we spent like 5 months. The deal dragged on for 5 months. The seller ended up walking away because, they didn't want to sell to us. So we lost money, but none of the passive investors lost money. We refunded every single penny to our passive investors. It's one of those ways you have to take as a, syndicator is if the deal goes south, you're going to be in on this game, for the long run. Priority number one is protecting investors' money. So if the deal goes out, get them all their money back. So every single investor got their money back on that deal. Me and my other partners, there were just two of us, as the lead sponsor on that deal. So we basically, lost the soft cost. I mean, the seller returned the honest money to us because it already went hard. But because they're the one walking away from the deal, they returned the honest money to us. But of course, as you know, there's always other soft costs like, syndication attorney, the appraisal and all those other soft costs, lender fees, all those are non-refundable. So we basically lost all those. And from passive investment, my first passive investment deal, basically, I saw all the nice things about the property, but did not do good job at betting the location. I think the syndicator might have been a little bit too aggressive with the assumption, and as a result, the property did not perform, and that's one of the lessons I learned in my opinion. So on all my deals, for example, I'm going to tell my passive, like, hey, we're going to get $100,000 in other income on this deal. That's what we're projecting. And this is example why. For example, we're going to install a wash and dryer, we're going to do this and that. But on the underwriting, I'm not going to factor that in, or a very small fraction of that in, into the underwriting. So that if that end up not being achievable, actually, there's a difference between an obvious thing versus something that you think can achieve. I think the most common, for example, is wash and dryer, right? It can easily show the numbers look really, really well if you had it into the underwriting. But the question is, what if you cannot achieve that, right? Because there's a good chance you will not be able to achieve it. So what if you not achieve it? Can the numbers still work? And as a syndicate, that's always what you want to show the investors, that hey, even though we're going to shoot for this, let's assume it's not achievable. Or let's only assume a very, very small fraction of it is achievable. So that, if it end up not being achievable, you don't end up being caught up in the middle.
Right. Nice. Yeah. No, it makes perfect sense. It's definitely, you have your estimates, and then you also have kind of when you're speaking to your investor, you give them the realistic view of something happens. You know what I mean? So,
Mm-hmm.
So
right.
how can our listeners learn more about you and your business?
Yes. So I have a website, Kindu Bay Properties. Kindu Bay, that's KENDUBAY as in dog, U-Y, KNDUB as in boy, AY properties. So kindubayproperties.com. They can easily come there and see some of our assets. Not everything is listed there, but because we are forever always adding more things and it's being constantly updated, but they can always come and see, some of our assets there. They can also reach out to me directly, through the website or call me on my cell phone, 818-635-4289. With any question, I'm always, available anytime to talk to anybody. And they can also connect with us on Facebook. So just Facebook/Kindubay Properties, and then you can easily find us there.
Okay, awesome. Yeah, I'll put all those links into the show notes. And I want to thank you so much, Jack, for being on the show today.
Thank you, too. Thank you so much. I appreciate it.
Talk to you soon.
Yes, thanks.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Harborside Partners Incorporated exclusively.